Okay, let's continue our discussion on market timing. So market timing basically talks about how you change your allocation between a market portfolio and a risk-free asset. So basically, if you think the market will outperform the risk-free asset, then you will invest more in the market. And if you think the market will decrease or the market will underperform the risk-free asset, then you will invest less in the market. So now our task is to evaluate. We want to ask, how can we measure a fund manager's ability to time the market? And we talk about this result in the last lecture. So basically, if you're not a market timer, that is, if you invest a fixed percentage of your money into the market, then if you plot the excess return of your portfolio versus the excess return of the market, then you will see that you will get a straight line. So how do you get this result? Well, let's say you invest 60% into the market index, and then the return of your portfolio would be 60% in the market and 40% in the risk-free asset. And you can see that this 0.4 times risk-free rate is essentially 0.4 minus, oh no, so it is essentially minus 0.6 risk-free rate plus 1 times risk-free rate, right? And then this means the following equation will hold, right? So basically you can see that we can find out if you invest 60% in the market, then the excess return of your portfolio and the excess return of the market will have the relationship, right? You can see that it is just a very simple straight line with a slope of 0.6. So this will give you the idea how to evaluate a fund manager's skill in timing the market, because you can see that ideally, right, if you think the risk, right, if you think the market return will be higher, right, then you should invest more money into the market, right? So basically, let's say, so basically this means that this number, let's call this number as X. So this basically means if the excess return of the market is larger, then X should be larger. That is, you should put more money into this market portfolio. So this basically tells you slope should be larger, right? So that's exactly what we get from the second picture, this one, right? Because you can see that if the excess return of the market is larger, the slope of the curve increases, right? So basically, if a manager can time the market, then we expect the slope increases as the market return increases. And you can imagine that if the slope increases faster, then this manager has a better skill in timing the market. Okay, and then we talk about the econometric implementation. So basically, you will try to do this following estimation, right? You will estimate the excess return of the portfolio P with respect to the excess return of the market. And then if we have a positive C here, then we would say this manager has this market timing ability. And you can imagine that if C is larger, then the market timing ability is actually larger. And then you can see that this is somewhat complicated because you have this squared here. So this can be simplified. These two people, right, they proposed a very similar but slightly simpler methodology. That is, again, you will regress the excess return of the portfolio with respect to the excess return of the market. However, now you can see that you're not having this squared here. Instead, you have this D here. D is basically a variable, which is 1 if the market return is larger than the risk-free rate. And if the market return is smaller than the risk-free rate, then D is just 0. And in the end, you can see that what you can get here is two different slopes, right? You will have a kink at this 0 point, because you can see that if D is larger than 1, then, oh no, not D is larger. If D is equal to 1, then you can see that slope is B plus C. And if D is equal to 0, then slope is just B, right? So basically you can see that if you can draw a picture like this, you can see that whenever the market return is larger than this RF, so you can see that C is larger than 0, right? So this again basically tells you that if the market outperforms the risk-free rate, then you will invest more in the market. So that's why you have a larger slope when RM is larger than RF. So this again implies market timing ability. Okay, so let's look at a very interesting experiment. So let's say we assume there is a perfect market timer. That is, this person can perfectly predict next year's return. So we assume this timer can perfectly tell at the beginning of each year whether the SP 500 will outperform this 1 month T-bill. So basically, if you draw out the timeline, then it looks like this. So basically, at the beginning of each year, this market timer will try to predict whether the market return or the risk-free rate will be larger. And if this market timer predicts SP 500 return is larger, then she will invest all her money into SP 500 for 1 year. After 1 year, again, she will make the prediction. Let's say this time she predict the 1 month T-bill will outperform the market. Now she would invest all her money into this 1 month T-bill for 1 year. Again, she will make the prediction after these 2 years of investment, and she will continue to do this until December 31, 2015. And the starting time was December 31, 1926. So we assume this perfect market timer would bet $1 on this December 31, 1926. And until December 31, 2015, we want to see how much she can earn. And you can see that for this perfect timer, right, the terminal value of her investment would be about, I think this is $500,000. Yeah, it's about $500,000, right, after about 90 years, right? And you can see that compared with equity and compared with bill, right, this terminal value of a perfect timer's investment is much larger, right? Obviously, you can see that this is quite hypothetical because it's actually pretty hard to predict whether SP 500 will outperform the T-bills in each year, right? Okay. Oh, by the way, you can see that we have some other statistics here, and you can see that for the perfect timer, you can see that its LPST is actually 0. Right? What is LPST? Well, we learned about this, right? It's the lower partial standard deviation. And it's calculated by returns, which is below the benchmark return. And you can see that for a perfect timer, right? Here, the benchmark return is T-bills. For a perfect timer, her return will never be smaller than the T-bill return. So the lower partial standard deviation has to be 0. Okay, now let's talk about the last section, which is called performance attribution. So here, our purpose is to understand what kind of decisions give us a particular investment performance. To be more specific, we wanted to attribute investment performance into two sources. The first source is called asset allocation, and the second source is called security selection. So basically, asset allocation refers to the choice that you allocate your money into different assets. For example, if you have $100, then you would invest $20 into the money market, $20 into fixed income, and $60 into equity. Then this is called asset allocation. And then the second source of investment performance is called security selection. So for example, you have decided to invest $60 into equity. And then it's important for you to understand what kind of securities you actually want to buy, right? So let's say you have $60 into the equity, and then you invest $30 into Apple and the other $30 into Google. Then in this case, this is called security selection because you have selected Apple and Google, and you have invested $60 into these two different stocks. Okay, so how do we exactly, right, do the attribution analysis here? Remember that our purpose is to attribute the performance of a particular portfolio into two sources: security selection and asset allocation. Right. So here, the basic methodology works like this. So let's say we want to evaluate a portfolio P. Right. So we want to evaluate P's performance. Then we wanted to compare P's performance with a benchmark portfolio B. So it's really about comparison in returns. And this benchmark portfolio B is called, by convention, a Bogey Portfolio. Now, how do we set up this Bogey Portfolio? Well, first, we will allocate across different assets in a usual or neutral fashion. And second, we will only invest in passive index portfolios within each asset. So basically, you can think about a construction like this. Right? right? So let's say I want to construct a benchmark portfolio. First, I'm thinking about a allocation across assets in a neutral fashion. So let's say I will invest 60% into equity and 40% into bond. Well, you might ask, so why do you choose 60% in equity and 40% in bond? Well, because we're trying to allocate using a yo-yo fashion, because this 60-40 split between equity and bond is quite common among investors. So I'm just trying to be yo-yo, right? Nothing abnormal here. And then I will only hold index portfolios within these different assets. So now I have decided to invest 60% into equity. I will only invest S&P 500 index portfolio. And then for the bond, I will invest a bond index. Right? So let's say I will invest in Barclays aggregate bond index. So the key here is, no matter how you construct your bogey portfolio, you want to make sure that this bogey portfolio is using a passive strategy, right? So this is important because if bogey portfolio is using a passive strategy, then you know that using bogey portfolio, you can rule out asset allocation and security selection, because whenever you're doing a passive strategy, then there is no asset allocation and there is no security selection. And then you compare the return of your portfolio P and the return of the benchmark portfolio. And then the difference in returns must be because of asset allocation and security selection, right? So basically you will calculate the return of your portfolio P and the return of the bogey portfolio, and you will look at their differences, right? Let's say the difference is 10%. Then you will know that the 10% must be because of asset allocation and security selection. The reason is because the bogey portfolio does not contain anything about asset allocation and security selection. Okay, so how do you calculate the bogey portfolio's rate of return? Well, it's pretty simple, right? So let's say I refers to asset I, and B refers to bogey portfolio, and RBI, right, is essentially the return from asset I, and this WBI is the portfolio weight of asset I, and N is number of different assets. Later you will see a example which will show you how to use these formulas. And then for portfolio P, so you can see that WPI basically means the portfolio weight of asset I in portfolio P. So RPI is the return of asset I in portfolio P. Right? Basically, you can see that to calculate the bogey portfolio's return, you will use the weighted average returns. And the same result holds for the portfolio P here. And then you will calculate the difference in the returns between these two portfolios. Okay, the next step is more important because we will try to decompose the return difference we just calculated, right? We calculate the return difference here. right? So we will try to decompose this return difference into two components. The first component is asset allocation. The second component is security selection. So let's see first the return difference here. You can see that according to this formula, right, the return difference is given by this formula. And we can see that essentially WPI RPI minus WPI RPI gives us the return difference in each different asset class I. So let me write this difference down. And then let's decompose this return difference. So what you can see here is, now I will do the decomposition here. Okay, you can see that the left-hand side equals the right-hand side because these two terms, they will just cancel with each other, right? And then this component is called security selection. And this component is called asset allocation, right? So why do they have names like this? Well, let's further combine these terms. So this one should be RPI minus RPI times WPI. So this one should be WPI minus WPI times RPI, right? So let's see why this guy is called asset allocation. Well, basically what you can see here is we are holding the return of the asset, right? So the return of asset I is always the return of asset I from the Bogey portfolio. What we are changing here is the portfolio weight, right? So basically it says that there is some difference in the portfolio weight in asset class I when we're looking at portfolio B versus when we're looking at the Bogey portfolio, right? And this is asset allocation. So okay, let me give you an example. So let's say if this WPI is 20%, and then this WBI is 10%. Let's say the RBI is 5%. So this basically says, given the asset I's return in Bogey portfolio is 5%, the fund manager allocates 10% more compared with the Bogey portfolio, right? You have 10% more because the Bogey portfolio has 10% invested. And then the portfolio P has 20%, right? So this is about asset allocation. Okay, now let's look at the first guy, right? This guy. So this is called security selection, right? So what you can see here is we are fixing the portfolio here. To be more specific, we're using the portfolio weight of asset class I from portfolio P. And then we're looking at the return differences. This is security selection because why RPI does not equal RBI? despite they're the same asset class I? Well, it's really because of security selection, right? So again, let me use some numbers. So let's say RPI is 20%, right? RBI is 5%. WPI is 10%. So this basically says that for asset class I, we invest 10% in portfolio P. And asset class I's return from the Bogey portfolio is 5%. But the return for asset class I in portfolio P is 20%. So why do we have a much higher return in asset class I when we're looking at portfolio P? Well, it's because the manager is actively selecting better securities in asset class I. So that's why RPI here is 20% versus 5% for RBI. Okay, and so basically we can actually draw a very nice picture about this performance attribution. So here you can see that the Bogey portfolio's return in ith asset is RBI times WBI, right? And then based on this Bogey portfolio's return, we can expand to the right or expand upward. When we're expanding to the right, we're talking about asset allocation. The reason is because asset allocation, right, is equal to WPI minus WBI times RBI, right? So you can see that this is basically RBI, and this is WPI minus WBI. So you can see that this area measures allocation. And then you can see that security selection is calculated by RPI minus RBI times WPI, right? So you can see that this is WPI and this is RPI minus RBI. So you can see that we have this shaded area as a measure of security selection. The key about this decomposition is really about you need to you really need to understand, you need to decompose this return difference into two components. And importantly, you need to understand why this component is about asset allocation and why this component is about security selection. And again, let me repeat. This guy is about asset allocation because you're having different portfolio weights. So when you're talking about allocation, it's about allocating more or less money, right? It's about changing portfolio weight. And then the second guy is about security selection. When you're talking about security selection, you're thinking about how can I achieve better returns through better security selection. So basically it means that if you're looking at the return difference, then you can see that the difference between RPI and RBI should be attributed to security selection. Okay, now let's see this example here. I hope this example will give you a clear idea how the performance attribution works. Again, remember the purpose is we will attribute the performance difference between our portfolio P and the Bogey Bogey Portfolio into two sources. The first is the asset allocation. The second is about security selection. Okay, so let's first look at some basic data points. So we have portfolio P and we have our benchmark portfolio. And portfolio P has return of 5.34% and Bogey Portfolio has return of 3.97%. And our portfolio P invests in three assets. So this is, I believe it is equity. So this is the return for bond. And this is the return for cash. Sorry, I should not say for cash. For money market. So money market basically deals with cash-like short-term investments. And then 0.7 is the portfolio weight in the equity, and portfolio weight in the bond, and portfolio weight in the money market. And you can see that now our purpose is to understand how to attribute this 5.34% return into security selection and asset allocation. So we want to build a Bogey portfolio. And now our Bogey portfolio has return of 3.97%. And you can see that because portfolio P invests in three assets, then the Bogey should also invest in three different assets. So this is the return of equity, return of bond, return of money market fund. And you can see that the return in equity when we're looking at the Bogey is different from the return in equity when we're looking at the portfolio P, right? This should be obvious because this 5.81% comes from a passive index, right? So it comes from SP 500. And this 1.45% comes from the Barclays Aggregate Bond Index, right? Okay. So having found out our Bogey portfolio's return, we can find the portfolio difference, right? This is easy. Portfolio difference is basically 4.34% minus 3.97%. And we get a difference of 1.37%. Now our task is, how could we attribute this 1.37% into asset allocation and security selection? Okay, so what we will do is we will try to use this formula here. Right? Okay, so let's see this table. First, we will try to think about the contribution of asset allocation into P's performance. Remember that when you're looking at the asset allocation component, you will keep the portfolio weight the same, and you will look at the difference. When you are looking at the asset allocation component, you will keep the return the same, and you will look at the difference in portfolio weights. So you can see that we're exactly doing this in table A, right? So what we're doing here is we will fix index returns. What is index returns? Well, it's RBI here, right? So it is just this guy. So we will fix index returns and we'll look at the differences in portfolio weight So what you can see here is these two portfolios, they definitely have different portfolio weights, right? So it's 0.7 in equity for portfolio P and 0.6 in equity for the Bogey portfolio. So you can see that we will write down the portfolio weight for the Bogey portfolio and the portfolio weight for our portfolio P. And then we'll look for the difference. Remember that the asset allocation is calculated by this formula, right? So basically you can see that we will use the difference in the portfolio weight times the index return, right? So basically here, this is 0.1, this is 581, right? So this gives us this number. And then we have three different asset classes. We have equity, fixed income, and cash. So we'll do the same for fixed income. So again, active weight or the difference in portfolio weights times index return. Again, for cash, the difference times the index return. And then we will sum up these three numbers. So this gives us 0.3099. Okay, this is great. So you can see that the total difference is 1.37%, right? And you can see that 0.31 can be attributed to asset allocation. Okay, now let's think about the second component, which is security selection, right? Now, the formula for security selection is you will look at return differences, because security selection will generate return differences. And then you will fix the portfolio weight, right? And to be more specific, the portfolio weight will be the portfolio weight of the portfolio P, not the portfolio weight of the Bogey portfolio, right? So you can see here, the portfolio weight, right, for equity is 0.7. Yes, it's 0.7, and for bond, it's 0.07, and for cash, it's 0.03, right? And then we will look at excess performance. Excess performance is just RPI minus RBI. That is portfolio P's return in asset class I minus Bogey portfolio's return in asset class I, right? So for example, for equity, you can see that the difference is 7.8 minus 5.81. Right? So that's exactly what we're getting here. So the return difference is given by 1.47. And then the return difference is, the return difference for fixed income is 0.44. What about the return difference for the money market? Well, they're the same, right? So the return difference here is just 0. And then again, we'll do the multiplication here, right? 1.47 times 0.7 gives us 1.03, right? And then we will sum up these two numbers, which gives us 1.04, right? So what you can see here is basically the 1.37% outperformance for portfolio P can be attributed to two components. So the first one is asset allocation, right? And this accounts for 0.31%. And next, it's about security selection, this will account for 1.06. And we can further decompose this 1.06 to two components. That is security selection in the equity market, 1.03, and security selection in the bond market, which is 0.03. So if you're evaluating a fund manager, this will actually give you an idea on this fund manager's different skills, right? You would know that at least from this performance evaluation, you would know that it seems that this fund manager is really great at doing security selection, right? And not so great in this asset allocation. So maybe because this guy is a really great so-called stock picker, right? So that could be the case. Okay, we have two more pages. So I will say these are not required. So basically the next two pages we'll talk about sector allocation. And I don't think this is very necessary. So it's not required. By the way, this part is also not required because I think I talked too much. So maybe it's better for me to reduce some course load. Okay, so the performance measure with changing portfolio composition is also not required. Because in reality, this is not the most important knowledge you need to know. So not required. Okay, that's great. Let's move on to the next chapter. So let's talk about portfolio optimization. So this is a really important topic and it's super useful. If you actually work for a financial firm, most likely this is one of the most important knowledge or skills you want to possess. So what is portfolio optimization? First, what is portfolio? Well, it's easy, right? So it's basically a collection of your investments, right? So if you have $1,000, then if you invested $200 into bond, $800 into equity, then this is your portfolio. And what is optimization? Well, think about this. You invested $200 into bond and $800 into equity. Now I want to ask you, why 800 in equity? Why not 700, right? So this is essentially a question about what are the optimal amount of money you want to invest in equity versus investing in bond, right? So that's portfolio optimization. That is, you want to solve the optimal portfolio weights in different investments within your portfolio. Okay, now let's first start with a simple concept, which is called capital allocation. It's simple because now our task is to understand how you should allocate between a risk-free investment and a risky portfolio. So the question is like this. Let's say you have again $1,000, and then you have this risk-free investment. Okay, let me call this risk-free. And then you also have this SP 500, right? So this one is risk-free, and this is a risky portfolio. Now the question is, how much should you invest in the risk-free asset versus the risky portfolio, right? Should you invest 200 versus 800, or 100 versus 900, or 700 versus, or 300 versus 700? Right? You can see that this is a pretty important question. The result is like this. This really depends on your risk preference. If you're more aggressive in taking risk, then maybe you should choose this. If you're more conservative in taking risk, then maybe you should choose this. Okay, that's the gist of this first section. Okay, now let's start. So basically, to understand capital allocation, we first need to define several important concepts. The first concept is about utility function. And if you have taken intermediate micro, then you should have learned about it. But I guess most of you guys have not learned about intermediate micro. So I will just do a very brief introduction on this utility function. So the purpose of the utility function here, at least in this class, is to measure how attractive a portfolio is. Now let's think about a very simple case. Let's say if you have a portfolio and I ask you, will you be happier if this portfolio gives you higher returns? Most likely you will say yes, right? And you can see that basically portfolio's attractiveness increases with return. And then if I also ask you, how about risk? You might say, well, I think the attractiveness of the portfolio will be smaller if the risk of this portfolio increases, right? So basically you can imagine that portfolio's attractiveness increases with return and decreases with risk. Basically, it says that for an investor, return is preferred, right? And risk is not. But if you recall what we have learned about in corporate finance, then we know that generally, most of the time, return increases with risk. Because basically there is no free lunch in the financial market. So if an asset, if an investment gives you higher return, then unfortunately, most likely you have to bear higher risk, right? So basically you can see that how to value a portfolio's attractiveness is not a clear-cut question, because you have to understand how return increases with risk and how investors will respond the fact that return increases with risk. Okay, so now let's see how could we define the utility function. It's actually a very simple function, at least in this chapter. So utility function is defined by several components, right? First, we have this expected return. And what is A here? Well, A is the measure of risk aversion. Right? So basically, if A is larger, then you're more risk averse. So if A is larger, then you're more risk averse. And sigma squared is the variance of your investment returns. So you can see that this is really a simple function. Even it has a fancy name called utility function. But you can see that it has only 3 components, right? So it's expected return minus the measure of your risk aversion times variance divided by 2, right? It's a really simple function. So don't get turned off by this utility function, this fancy name. Okay, generally in economics, most of the time we assume A is larger than 0. And if A is, oh boy, I have some typo here. So if A is larger than 0, then it means you're risk averse. And if A is smaller than 0, then it means you're a risk lover, you love risk. And if A is equal to 0, then it means you're risk neutral. That is, you don't really care about risk. Now, why do we have names like this? Well, think about this, right? So let's say we have a utility function. It looks like this. Let's say A is -1, right? And then, okay, let me start with a positive number. Let's say A is 2. So if A is 2, then the utility function will be this, right? So this basically means if variance of your return is larger, utility will be smaller, right? Utility is a measure of the attractiveness of the portfolio. So it basically means portfolio becomes less attractive, right? So you can see that the story here is basically as the variance increases, the risk increases. And because the investor is risk averse, the attractiveness of the portfolio decreases. And you can also see that if A equals -2, in this case, we will have a risk lover. So you can see that if variance increases, utility increases. It means portfolio becomes more attractive. This is definitely a risk lover, right? Because as risk increases, the attractiveness of the portfolio actually increases. And we could also say the case when A equals 0. So in this case, you can see that if A equals 0, right? Now you can see that the utility function does not depend on variance. That is, the attractiveness of the portfolio does not depend on the risk. So this investor is basically risk neutral. And you can also see why generally we assume A is larger than 0, right? Because you can see that it is the most natural assumption, because we know that generally investors, they don't like risk. If they don't like risk, then we require the risk parameter A to be positive. Okay, as I said, after defining the utility function, then we could actually measure the attractiveness of different portfolios. So let's see, now we have 3 different kinds of portfolios. Portfolio L, portfolio M, and portfolio H. And you can see that from L to H, their return increases and their volatility also increases, right? So you can see that it's not a simple or clear-cut answer on which portfolio is preferred if you don't have the utility function here. So now we could use utility function to rank these different portfolios for different investors. So let's say we have 3 investors. And these investors, they all have positive risk parameters. So this means they're all risk averse. However, they have different levels of risk aversion. The first guy has a parameter of 2, the middle guy has 3.5, and the last guy has 5. So clearly this tells you that the guy with a 5 risk aversion parameter is the most risk averse, right? And now our question is, what is each guy's most preferred portfolio? So what we can do is we will just plug in numbers into this utility function, right? And you can see that after plugging numbers for the first guy with a risk parameter of 2, we get 3 utilities. And since utility measures the attractiveness of portfolio, so we can see that this is preferred. And then we could do the same thing for the other 2 investors. And then we can see that these 2 portfolios are preferred, right? So you can see that by using utility functions, it's quite easy for us to find out which portfolio is preferred for any investor as long as we know this investor's risk aversion parameter. Okay, the second concept we need to understand is capital allocation line. This is actually quite simple. Even I will talk about some formulas. It's something like this. Let's say you have a risk-free asset and you have a risky portfolio. And then if I draw a line which connect these 2 dots, right? If I draw a line like this is capital allocation line. You see that it's very simple. The not so simple part is about the slope of this capital allocation line. So let's see how this works. Okay, so now we want to create a mixed portfolio by investing in the risky portfolio P and risk-free asset F, right? So basically, we have F and P. And now we wanted to invest in both P and F. And we call this combined portfolio as a mixed portfolio, right? That is, you have portfolio P and you have the risky asset. And then you will invest in both of these two portfolios. Now you will have a larger mixed portfolio. And now let's say you invest Y into portfolio P. And Y is a percentage. Let's say if Y equals 20%, then it means you put 20% of your money into portfolio P. And you can see that if you put a percentage of Y into portfolio P, then you will invest a percentage of 1 minus Y into this risk-free asset F. Now the question is, what is the mixed portfolios or the combined portfolios return and the combined portfolios volatility? Well, let's see how can you calculate this. We have portfolio P and we have risk-free asset F. And then we invest Y into P and we invest 1 minus Y into F. This will give us a combined portfolio C. So the return of portfolio C equals the portfolio weight of P times P's return plus the portfolio weight on F times the risk-free rate. So this would basically give us the formula like this, right? So it's exactly this formula here. And then the this formula on standard deviation is slightly more complicated. It takes a little bit more time, but still it's quite simple. And this was discussed in corporate finance too. So it's your task to find out how to get this formula. So basically you can see that if portfolio P has a volatility, which is given by sigma P, right? That is, the volatility of P is given by this. And then you can see that if you invest 20% into this portfolio P, then the combined portfolio's volatility would be 20% times portfolio P's volatility. So we are talking about this because we want to find out a formula for this capital allocation line, right? How do you get this formula? Well, to get this formula, you want to remove this y, because we want to find out how RC and sigma C are related. Right? So this basically tells us y equals sigma C divided by sigma P. So now I could pretty much plug in this into the first equation, and this gives us an equation like this. So this equation tells us the relationship between the return of the combined portfolio and the volatility of the combined portfolio. So if you write, okay, I think you can actually write this equation in a better way. So our focus here is these two guys, right? As I said, you want to understand how the return of the combined portfolio and the volatility of the combined portfolio are related. And then you can see that this guy basically gives you the slope of this capital allocation line. And capital allocation line is basically given by this equation. Okay, let's see what is capital allocation line. So let me write this formula here. So ERC equals RF plus ERP, yes, minus RF divided by sigma P times sigma C. Okay, so let's say now we have some data here, right? So let's say our F is 7%. Let's say we have this as a 7%. Let's say sigma P is given by 22%. So it is 22%. And the expected return of the risky portfolio is, let's assume it's 15%. So we will have something like this. Right? So we will have something like this. That is, if you draw the expected return of the combined portfolio on the vertical axis, and if you plot the volatility of the combined portfolio on the horizontal axis, you will find out this is a straight line, right? And you can see that the vertical intercept is given by the risk-free rate 7%, and the line's slope is given by 8 divided by 22, right? So basically you can see that this is a line which connects the risk-free investment and the risky portfolio. This is called capital allocation line. So why this is called capital allocation line? Well, because it tells you what kind of return and volatility you can get if you allocate capital between risk-free rate and the risky portfolio. So for example, if you put 50% into the risk-free investment and 50% into the risky portfolio, then you can see that you will be here, right? So this point will tell you what kind of return you can get and what kind of volatility you can get, right? So that's why this is called capital allocation line. Okay. Oh, I forgot to mention. The slope of the capital allocation line is the portfolio P's Sharpe ratio, right? Because you can see that because you can see that slope is given by this, and it's exactly the definition of Sharpe ratio. So equals Sharpe ratio. And another thing you can see that the capital allocation line can be uniquely determined by the risk-free rate and the Sharpe ratio, right? So basically, let's say if you tell me the risk-free rate is 5%, right, then I would pick this point. If you tell me the slope is 1, then I would know that the capital allocation line looks like this. And if you tell me that the slope of capital allocation line is smaller than 1, let's say it's 2/3, then I would know that the capital allocation line should look something like this. Okay, let's see an example and see how we could use this capital allocation line to how we could use these numbers, right, to draw this capital allocation line. So let's say a investor, right, a investor can lend money at 7%, but she could only borrow at 9%. Right? Well, because generally when you're a borrower, right, you will be charged at a higher interest rate. So let's say the risky portfolio has a 15% return, and its risk is 22%. Now draw this capital allocation line. You can see that to determine the capital allocation line, we basically need two things, right? We need risk-free rate and slope. Or instead, you could use risk-free rate and the risky portfolio. Okay, so let's see how could we find out the capital allocation line. Okay, so we have basically two interest rates, 7% and 9%. And then we have the risky portfolios volatility, which is 22%, and its return is given by 15%. So it should be here. And then you can see that the investor can only lend at 7% and borrow at 9%. So what does this mean here? Okay, think about this. Let's say you're here. What you're doing is you're investing 50% into risk-free asset and 50% into this risky portfolio. So here when you're investing 50% in the risk-free asset, it means that you're lending money, right? Now let's look at this a different point. So let's say we're looking at this point. Now assume at this point you invest 150% into portfolio P and minus 50% into this risk-free asset. Right? What does this mean here? It means you're borrowing money to buy portfolio P. That's why you could have a portfolio weight of 150%, right? So it's really a leverage. So it's really a leveraged portfolio here. So basically you can see that if you have two interest rates, your capital allocation line will look different because for the section on the left side of P, that is here, you're lending money. So you should use the interest rate of lending out money. And then on the right side of portfolio P, you're borrowing money. So you will have different interest rate. To be more specific, you should use the interest rate when you're borrowing money, right? Okay, great. Now, what is the rate if you lend? Oh, it's 7%. So we just connected this. And then on the right side of portfolio P, you're actually borrowing money. So we should use a different 9%. Now, what is the slope after or on the right-hand side of portfolio P? Well, it's just RP minus RF divided by sigma P. So it should be 15% minus 9% divided by 22%. So slope here is 15% minus 7% divided by 22%. So what you can see here is the difference, right? We have different interest rate. You can see that this one is 7%. This one is 9%. So basically it means that the slope with 9% interest rate should be smaller, right, compared with this one. This means if you draw the capital allocation line on the right side of portfolio P, it should have a smaller slope. How do you draw a smaller slope? Well, it's easy, right? Because it means the line should be flatter. Right? So it looks like this, right? So you will basically have a kink at portfolio P. Okay, this is for, okay, that's for today's lecture.